Hello friends, welcome to the world of business studies by my YouTube channel Clear Concept. In the last discussions, we have covered BST Part 1 of NCERT. Now, in this discussion, I'll be starting with BST Part 2, which first chapter is chapter number 9, Business Finance, in which I'll be covering the topics like meaning of business finance, meaning of financial management, and the role of financial management. Now, moving to the first slide is meaning of business finance. Business finance refers to the money and credit employed in business. It involves procurement and utilization of funds so that business firm may be able to carry out their operations effectively and efficiently. Now, I'll be explaining you the meaning of business finance more in detail. Like money is essential to start, run and grow any business. Even maintaining your business competitive edge and customer base will require some investment to be made over time. Business finance is the management of money and other assets in a business. Financing is an act of bringing money into business for the purpose of expanding operations or purchasing new assets. Entrepreneurs need to fully understand the principle of financing in order to keep their business profitable. These principles include accounting methodologies, investment strategies, debt management, and etc. While accounting track and organizes your company's financial information, business finance uses the information to help you manage your money and make your operation more profitable. Business finance includes reading financial statements and collecting the dots between your profit and loss, balance sheet, and cash flow statements. If these documents point out to a shortage of capital, business finance also provides the tool to plan strategies for bridging the gap. This was all about business finance. Now moving to the next one, that is financial management. Financial management means planning, organizing, directing and controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying the general management principle to financial resources of the enterprise. Now, let me explain you more about financial management. Financial management may be defined as planning, organizing, directing and controlling the financial activities of an organization. The activity concerned with the planning, raising, controlling and administrating the funds used in the business. It is considered with procurement and utilization of funds in the proper manner. Financial activities deal with not only the procurement and utilization of funds, but also with the assessing of needs for funds raising, requirement, finance, capital budgeting, distribution of surplus, financial control, etc. Now, the nature of financial management are as follows. Financial management is properly viewed as an integral part of overall management rather than a staff specially concerned with funds raising operations. In this broader view, the central issue of financial policy is the wise use of funds and the central process involved in rational matching the advantage of potential uses against the cost of alternative potential sources, so as to achieve the broad financial goals which an enterprise sets for itself. In addition to raising financial funds, financial management is directly concerned with production, marketing, and other functions within an enterprise wherever discussions are made about acquisitions or distribution of funds. Now, next topic is uh, the role of financial management. Now, these are few points. I'll be telling you one by one. The size as well as the composition of fixed assets of the business, the quantum of current assets as well as it breaks up into the cash, inventories and receivables, the amount of long-term and short-term financing to be used, breakup of all long-term financing into debt, equity, etc., all items in the profit and loss account, example interest, expense, depreciation, etc. Now let me explain you all the points one by one in detail. Now moving to the first point, that is the size as well as the composition of fixed assets of the business. Now fixed assets have an important contribution in the profit of a business organization. Under the financial management, the total investment in the fixed assets and every separate fixed asset is determined. For example, if it has been decided in the capital budgeting to invest rupees 500 crores, there will be an increase of rupees 500 crore in the fixed assets. Now the next point, that is the quantum of current assets as well as it breaks up into the cash inventories and receivables. Here, the current assets are needed in the day-to-day transactions of business. Under the financial management, the total investment in current assets and every separate current asset is determined. For example, if the investment in current asset is rupees 100 crore, it will be determined how much should be invested in cash, stock, debtors, etc. Now the next point, that is the amount of long-term and the short-term financing to be used. All the financial needs of a business are fulfilled through the long-term and short-term sources. Under the financial management, a proportion of both the financial sources is determined. Next, that is break up the long-term and the short-term into debt, equity, etc. Long-term financing sources include primarily equity share capital, preference share capital, retained earning, debenture, long-term loan, etc. Under financial management, the proportion of various long-term financial sources is determined. All the sources have their merits and demerits. After making an analysis of their merits and demerits, a balance decision is taken. Or you can even say that a proper decision is being taken. Now the last point, that is all items in the profit and loss account, example interest, expense, depreciation, etc. Various items included in the profit and loss get influenced or affected by the different financial discussions. For example, interest is related to the amount of debt, depreciation is related to the amount of long-term asset. Discount is related to the position of liquidity, which means that if the position of the liquidity is good, discount can be earned by making timely payments, etc. These were all things we need to discuss in this discussion. Now, in the next discussion, we'll be continuing our discussion on topics like objectives of financial management, like profit maximization, wealth maximization, proper utilization of financial requirements, obtaining funds at a minimum cost, proper utilization of finance, maintaining proper inflow and outflow of cash, risk minimization through creation of reserves, proper coordination, financial control, and creation of goodwill. And even we are going to cover the financial decisions. Basically, there are three types of decisions like investment decision, financing decisions, and dividend decisions. I'll be explaining you all these decisions in detail in the next lecture. And the next topic we'll be covering is factors affecting investment decision. There are three factors that affect the investment decision. First one is cash flow of the project, the rate of return, and the investment criteria involved. These will be explaining you in the next discussion. Till then, let us know your doubt or any specific query below in the comment section. Subscribe us and ring the bell button so that you won't miss any important update. Till then, enjoy studying business studies.